the worst performing Asia currency till now in 2026.
Is the rupee really in crisis or just under pressure?
The rupee touched an all-time low of 96.96 against the dollar. And that is approximately 14% of rupee's depreciation. Five powerful forces all hitting at the same time. When the rupee weakens, your fuel cost increase. Nearly 85% of its crude oil from overseas. When the US-Iran conflict erupted and disrupted the Middle East energy supply chains,
What could actually help the rupee recover?
the RBI is controlling the speed of the fall and not the direction.
Have we seen situations like this before in India's history?
A weaker rupee isn't all the bad news for everyone.
A lot of now depends on how global events unfold.
India's overall trade deficit hit a record.
Hello everyone, I am Varun Waldia from Anand Rathi Shares and Stock Brokers. Welcome to our podcast where we break down the biggest economic stories shaping your money, your future and India's financial landscape. Today we are decoding one of the biggest conversations in the country right now, the falling Indian rupee. Why is the rupee weakening? How does it affect your daily life? And should India actually be worried? To help us understand what's really happening behind the headlines, we have with us Mr. Naveen Mathur, Director of Commodities, Currencies and International Business at Anand Rathi Share and Stock Brokers Limited. Naveen sir, thank you so much for joining us.
Thank you, Varun. It's great to be here. It's a very important conversation as the rupee movement affects all of us in one way or the other. I'm looking forward to this conversation.
Great. So let's get started. Everyone's suddenly talking about the falling rupee right now. What's really happening here?
So, Varun, that's right. It's a very real and a burning issue with respect to the Indian macroeconomics. And let me share why 96 is not just a number, it is more than that. 2 years ago, the rupee against the dollar used to be around 83. Today, we are at 96 to a dollar. That is about 16% of a fall over the last 2 years of rupee against the dollar. Now, over the period of last, I would say 14 years or so, the rupee has depreciated by about 60% against the US dollar. And now you might think that this particular problem is not related to me. It is for the people who are either having the currency exposure or for the economist. But the truth is, when the rupee weakens, your fuel cost increase, the cost of the imported goods rise. At the same time, your travel budget or the overseas education cost also rises. And the inflation quietly rises for the whole country. Let me share with certain numbers on inflation. 5-6 months earlier, the consumer inflation was around 1% or less than 1%. Currently, it is around 3.5%. So that's a story for you too.
And that's the part people often miss. And the rupee falling isn't just a market story, it eventually impacts everyone. So, just to put things into perspective, how sharply has the rupee actually fallen over the last few months?
Sure, in March 2025, the rupee was at around 85 to a dollar. This year in January, the rupee closed at around 92 to a dollar, which was a record low at that particular point of time. Then came March. With the West Asia crisis, the crude oil prices surged to approximately $120 a barrel, which impacted the rupee too. The rupee closed at around 95 by March end. Just yesterday, the rupee touched an all-time low of 96.96 against the dollar. And that is approximately 14% of rupee's depreciation against the dollar over the last 11 months. So in the current calendar year, the rupee has depreciated over 7% against the dollar and is the worst performing Asia currency till now in 2026. If you see it this way, even in 2013, the rupee depreciated against the dollar to an extent of around 9 to 10%. So I think we are firmly into that particular territory again.
Those are pretty alarming numbers. But why is this happening? Is the rupee really in crisis or just under pressure?
So, Varun, the rupee's depreciation in 2026 is not a single cause story. It is a perfect storm, five powerful forces all hitting at the same time. The force number one, oil shock. India imports nearly 85% of its crude oil from overseas and we pay it in US dollars. When the US Iran conflict erupted and disrupted the Middle East energy supply chains, including the near blockage of the Strait of Hormuz, the Brent crude shot up from around $60 a barrel in mid February to above 107 in March and has stayed elevated above 105 since. At peak, the India's oil basket crossed $150 a barrel. When the oil prices double, India needs roughly to pay double the dollars for the same energy imports. Oil companies were constant buyers of the US dollars in the forex market, creating a relentless demand pressure on the rupee. A simple but devastating arithmetic. Force 2. The foreign portfolio investors' outflow, the foreign money leaving India. When the global uncertainty spikes, foreign investors flee emerging markets and they run to safe havens. And the US dollar is the world's biggest safe haven. The foreign portfolio investors, as of this particular moment, has pulled out about $25 billion from Indian equities and bonds in 2026, with over $12 billion leaving in March alone. Just to compare this particular figure to the previous year, the foreign portfolio investors' outflow has been about $19 billion for the full calendar year of 2025. When FPI sells Indian stocks and bonds, they convert their rupees into dollars to move the money back home. That's billions of dollars of extra demand flooding the forex market, pushing the rupee down further. Force 3. The US tariff blow to the Indian exports. The Trump administration imposed steep tariff between 26 to 50% on Indian exports, including gems, jewelry, electronics, auto components last year. The US is the single largest export partner for India, accounting for roughly 15% of India's foreign exchange earnings from trade and remittances. When those export earnings shrink, fewer dollars flow into India. Less dollar supply, same dollar demand, the rupee weakens. Now let's talk about force 4, a widening current account deficit for India. India imports are now significantly exceeding exports, a structural imbalance. The current account deficit is estimated at about $40 to $50 billion wider than in recent years. India's overall trade deficit hit a record $41.68 billion in late 2025 and has remained elevated since. India's April trade deficit jumps to $28.38 billion versus estimated $25.97 billion. So, Varun, the important point is a persistently large current account deficit means India is constantly a net buyer of a foreign currency, which keeps the rupee under the structural downward pressure. So the force 5, The interest rate gap is narrowing between India and the US. Here's the less talked about force. The RBI cut its repo rate to 5.25% in December 2025, narrowing the interest rate advantage that India offered over the United States. When Indian bond yields less relative to the US bonds, the global capital finds India less attractive. Money flows toward higher yields, and that means more dollars flowing out of India and fewer coming in.
Oh, right. So this isn't one single issue, it's multiple pressures hitting the rupee together. So, after understanding all these forces impacting the rupee, where does the RBI come into picture? Is the central bank stepping in?
Yes, the RBI has been actively fighting, but the nature of that fight tells its own story. India's forex reserves hit a peak of $728 billion in the week ending March 27th, 2026, a record high just before the start of the war. Since then, the RBI has been selling dollars from those reserves in order to slow the rupee's fall. The reserves currently has fallen to about $691 billion, a drawdown of nearly $38 billion in just 11 weeks. In March alone, the RBI is estimated to have sold 26 to 27 billion dollars in the spot forex market. The RBI has deployed other tools too. It capped banks' daily foreign exchange positions at about $100 million, restricted the non deliverable forward market activity, and at the same time tightened the bank arbitrage routes that were amplifying the rupee's fall. But here's the honest assessment. As it seems, the RBI is controlling the speed of the fall and not the direction.
So clearly, the RBI is trying to contain the damage, but it also has its limitations. Okay, so let's bring this closer to everyday life. What does a rupee at 96 actually mean for regular people?
Let's take the hit list first, particularly for consumers. Every important product, from crude oil to electronics to edible oil and fertilizers. The government has increased fuel prices at the pump to an extent, but that cannot last forever. When it does pass through, the transportation cost, the food prices, and the manufacturing cost will all rise. This is called an imported inflation, and it is now a real risk to India's otherwise benign consumer price index. For students and travelers, overseas education just got more expensive. A course costing about $50,000 that cost about 41 lakhs or so 2 years ago now costs about 47.5 lakhs, a jump of around 6 lakhs or so from the currency move. Foreign holidays, medical tourism abroad, and any dollar denominated spending face similar cost escalations. For importers, any businesses that imports raw materials from capital goods to chemicals to consumer electronics is seeing cost inflation bite into their margins. Now the silver lining, because of all the pain points, a weaker rupee isn't all the bad news for everyone. The IT and pharma exporters are the biggest winners. These companies earn revenues in US dollars but report earnings in Indian rupees. When the rupee weakens, every dollar of revenue translates to more of the rupee, boosting exported margins and profits. The broader export sector from textiles to engineering goods, also gains from the competitiveness as Indian goods become relatively cheaper for foreign buyers. Last but not the least, Varun, investors on the gold ETF also benefit mechanically. Since gold is priced internationally in dollars, a weaker rupee means that domestic gold prices rise even in international gold prices don't move.
It's interesting. While a weaker rupee does create pressure on everyday expenses, but it also opens opportunities for certain sectors and certain investors. So, just out of curiosity, have we seen situations like this before in India's history?
Yes, we did. India has faced currency crisis before, and each time the pattern has been instructive. The 1991 was the most severe, a full balance of payment collapse. With India, I think, pledging its sovereign gold to the Bank of England for an emergency IMF loan. That was the shock that forced India to liberalize its economy. Again, in 2013, the rupee fell nearly 10% in a year amid the US Federal Reserve's taper tantrum when the Federal Reserve signaled it would reduce the bond buying program. Capital flooded out of the emerging markets as it is right now, and India was hit hard. So recently, in 2022, the Russia Ukraine war drove oil prices above $100 a barrel. The Fed began its aggressive rate hikes, and the rupee fell sharply, prompting the government to hike the import duty on gold and silver to 15% to curb the current account deficit. Each episode had a trigger, a policy response, and eventually a recovery. The structural lesson from India's history is that the rupee tends to find a floor when the global shock eases, the oil prices stabilize, and the capital flows start coming in. India has never experienced a runaway currency collapse, largely because of the strong forex reserve, a diversified export base, and an active central bank management.
That's reassuring in a way because history shows that India has faced similar pressures before and eventually recovered. So, looking ahead now, what could actually help the rupee recover?
Now, let me talk about a few key catalysts. A ceasefire or a de escalation in West Asia crisis would be the most powerful single catalyst. If the oil prices fall back toward $80 a barrel or so, the pressure on India's import bill eases dramatically, and that is the most direct relief value for the currency. The second would be the US India trade deal, which market participants have been closely watching and could significantly reduce tariff uncertainty and restore dollar inflows from exports. If finalized, some estimates suggest that the rupee could recover towards 88 to 89 to the dollar. Third, and the foremost important, is the renewed FPI inflows, which the RBI Governor Mr. Sanjay Malhotra has said he expects to improve, especially in technology and the financial services, would bring the fresh dollar supply into the market and provide direct support.
So, a lot of now depends on how global events unfold, especially the oil prices, geopolitics, and foreign investor confidence. So, before we wrap up this session, what's that one thing you think every Indian should understand about this situation?
The India's rupee story in 2026 is not a story of economic failure. India's fundamentals, the GDP growth, the domestic consumption, the digital infrastructure remains pretty strong. But the currency markets are brutally honest about external shocks. And right now, the external vulnerabilities on oil dependence, capital flow sensitivity, and a wide trade deficit are all being tested at the same time. So, what is within India's control and what policymakers definitely know is that the long term answer lies in deeper structural shifts, reducing the oil dependence. Second, building export competitiveness. And lastly, attracting stable foreign direct investments and expanding rupee trade with partner nations. In the near term, we expect the rupee to trade in the range of around $95 to $97, with the next key level of concern being 97 to the dollar. The rupee will find its floor. It always has. The question, as always, is how much pain the journey there costs.
Thank you so much, Naveen sir, for coming today and sharing such insights on such an important topic. And with that, we come to the end of today's conversation. It was truly a pleasure speaking with you, sir.
Likewise, Varun, the pleasure was absolutely mine.
If you enjoyed this episode and found it insightful, do share it with your friends and let us know what topics you would like us to discuss next. I am Varun Waldia. Thanks for watching, and we will see you in the next episode. Until next time, stay informed, stay curious, and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.